Good afternoon, ladies and gentlemen. Welcome to the Diverse Income Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Claire Long. Claire, good afternoon.
Thank you, Jake. Good afternoon, everybody. Thank you for joining us. This is partly by way of an opportunity for Gervais to give the AGM presentation that he gave at the physical AGM today, and also an opportunity for those of you who would like to do so to pose questions to Gervais. Before I hand over to Gervais, there are a couple of pages of risk warnings and important information that I would ask you to read. Please bear with us. Thank you. And without further ado, I will hand over to Gervais. Gervais.
Thank you very much. And thank you very much for coming on the call. Markets are moving. The general view is that, if you speak to economic professors and things, more uncertainty equals more volatile markets. Well, now we find that volatile markets can mean they can go up a lot faster, we think, rather than just down, which is great news. Just as a starting point, if you remember, Martin and I set this trust up in 2011. The specific feature about many of the Premier Miton funds is that we're not here to just try and keep up with the mainstream funds, outperform the indices. We're here to hopefully generate something which is actually tangibly different and actually delivers more value. It's less correlated. But specific in this case, the trust is a multi-cap approach. In other words, we invest in mainstream companies, we invest in younger businesses, we invest in AIM stocks, and most particularly we invest right the way across the full range of companies, different industry sectors, not just the mainstream sectors, but including energy stocks, some capital intensive businesses, perhaps some property stocks, and even some miners. I'm sure we'll be mentioning those later. But to move on, I mean, the real agenda here is actually about what's the opportunity for the trust. So if we look back, can we move on?
We can move on.
Yeah. So if you look at the agenda here, first of all, I want to talk a little bit about the distortions. Markets have had a crazy period of returns over recent years, but they've been very distorted. And I want to talk a little bit about, not just about the distortion, but about the nature of risk which comes with that distortion. Recently, we've seen uncertainty, and we've got to think about the impact, specifically, not just, can markets be volatile, but most particularly, can, lower risk equity income stocks really outperform global stock markets on a long-term basis? And then we'll talk a little bit about what happens if there is a global recession, how we can navigate that, and most particularly whether UK small caps, it's a small investment universe, whether that ever is going to recover. So without further ado, I just thought I'd just talk about just quite how much capital has been sort of drawn into many of the very largest companies in the US. This is on the left-hand side showing the FTSE World Index, in pounds rather than in US dollars, but you can see that £1 invested in the FTSE World Index would be worth £3. That's a perfectly acceptable long-term return, not unusual for markets. What has been totally extraordinary isn't just how much many of the US Magnificent Seven have appreciated, but actually the scale of that appreciation. We're looking here at £1 being worth nearly £27. So effectively, most investors have changed their behavior over the last 5 years. Not so much 5 to 10 years ago, but particularly in the last 5, we've seen this great surge of liquidity backing these companies. The valuations have moved up. They've invested more quickly in AI and grown their businesses quickly. That's been excellent too. But most particularly, the net effect has meant that actually capital's been sucked out of everywhere else. Not just UK stock equities. We can talk a little bit about the UK market being lowly valued. Small caps, yes, they've been even more adversely affected. FTSE 100 have held up to some degree by actually buying back shares. Small caps do less buying back shares, they're investing more rapidly. But even US small companies have underperformed as well. It's not just a UK feature. So we've got this really massive distortion. And the big question isn't so much about why is it there, but actually, what are the blind spots? And my view is that the blind spot is that actually people have got very correlated positions. If you hold one of the Magnificent Seven, you've got probably 6 or 7 other stocks which are very correlated to it. And secondly, the scale of them is so big, $4 trillion, extraordinary. These are companies where, you know, if you've got a stock-specific position in a portfolio, you may have the same position replicated in lots of other portfolios. So ultimately, if it does peak out for whatever reason, you don't just get a stock-specific setback in a single portfolio. You could find it having a sort of systemic effect across markets. And of course, many of these are operating in the same industry sectors. So if you get a setback in AI or technology or whatever, then you could see a structural setback. You know, .com was tiny in comparison to what we've got now. So we've got this kind of extraordinary position mixed with the electorate voting for change. They voted for change even 10 years ago with Brexit. But what's really been happening is distorting markets prices by QE and other things has led to, in many cases, misallocated capital. Misallocated capital has meant that productivity has not improved. So if you look at the last 5, 10, 15 years, we're looking really at the global world, the global productivity hardly improving. And many of the electorate are saying, it's not working for me, we'll try something else. And so we have seen not just the election of Trump, Mark II, clean sweep, but on top of that, of course, many of the right-wing parties have got increasing support in Europe as well. So the net effect is that more of the same is less likely. We are beginning to get to a stage where this kind of globalization, which has been very much about being nice to people, you know, I will compromise, you compromise, and together we'll get a better outcome, has moved very much to me first and you second. And if I happen to be big, I can be a bully and kick you a couple of times as well. So the net effect is that actually, despite all the market appreciation we've seen, investment in AI has been boosting market appreciation this year. A lot of governments are running bigger budget deficits. That's boosting growth in the short term, but it's only a short term. We are looking now at a pattern change. Ultimately, there's going to be more uncertainty out there. Many companies are going to get caught out. The next downturn, don't expect all the zombies to survive. This is going to be a period which is much more uncomfortable. Many of the most vulnerable companies will become insolvent. Obviously, many of the other companies which are strong will survive. But most particularly, this is an opportunity where the winners will win and the losers will lose. And active stock selection doesn't just reduce risk, but actually enhances return. So when you look back, the purpose of the trust isn't just to generate some good and growing income. It has been successful in that. We're pretty excited about the prospects for it in the future, but most particularly to invest across a much wider range of stocks. And in doing so, to pick out stocks where sometimes you don't just get success, but you get success where these companies can move up 3, 4, 5 times the original investment price. Now, this has been a difficult time in the last 5 years. Over the last 5 years, not many small companies have increased that much. But even so, the trust has still picked out a few. And you can see here, you know, some of the companies like XPS and Galliford Try have moved up 3 or 4 times. But most particularly, even since this slide was put together, we've seen other companies continue to come through. So Pan African Resources, a gold mining company, for example, has continued to appreciate, and that's probably gone up 5 times since we first invested. So the purpose of the fund isn't just to invest in good and growing income, not just to get a better income growth than most others, not just to slightly outperform the mainstream peer group, but ultimately we allow ourselves, by investing across the wider investment universe, and particularly by picking out some younger companies, some smaller companies, to allow the upside to be more significant. Not so much in the last 5 years, but generally. So when you look at the outcome, effectively, you get companies like this. Galliford Try, one of the largest holdings in the trust. It's been in the portfolio for the last 5 years. And what you can see here is that the valuation of this company, the share price has moved up 4 times over that period. Lovely. And we love companies moving up 4 times. But the reason for including it here is to show that many of these companies, because we've been in this period of globalization and a lot of the small companies and the younger businesses are overlooked, actually the valuations at entry are often subnormal. And when they do succeed and perhaps expand more rapidly than perhaps people had expected, it means even after this period of substantial outperformance, in this case, it's gone up 4 or 5-fold. So coming back to it, there's a combination of factors. One, many quoted companies in the UK are cheap. Many smaller quoted companies are extraordinarily cheap. And secondly, two, we're investing in many of the companies, and when they succeed, they can sometimes succeed disproportionately on the upside. Move on. So anyway, going forward, the globalization has really been defined by valuation improvements. If you've had a house in the last 30 years, you know it's gone up an awfully long way. And the same is true with stock markets. Stock markets have done extremely well. Global growth has been excellent, expansion of margins, but most particularly, it's really been about share prices moving. And so nearly everyone is a transactional investor. They buy low, sell high. And you can see here that actually, when you look at the total return of the global stock market since the trust was set up in 2011, that actually it's hopelessly dominated by the appreciation of certain share prices, particularly the Magnificent Seven, but many other companies. So that actually the total return from the income, not just the income, but the extra growth of that income over time, is relatively modest. Meanwhile, as capital is being drawn from other markets, the UK markets is perceived as a dull market. Companies there aren't growing particularly rapidly, they pay a lot of income out. You can see that actually valuations in the UK have actually fallen, so the capital appreciation has been very low. And even though it's generating more income, overall the total return has been very disappointing. So we're in a period really where the opportunities to pick out stocks are very attractive. We're very upbeat about the potential for the trust to make good money. That's useful in a way, because actually what we've seen in the last 5 years isn't just that mainstream companies in the UK haven't outperformed, they've been fairly dull. We've seen a surge of low-cost capital, of OIC redemptions, which have driven capital into the US and other places around the world, and so that's held back valuations. UK mainstream valuations have been held up to some degree by buybacks, extra buybacks, but small companies have heavily underperformed. That's not because they've traded badly, it's not because they've all had profit warnings, specifically their valuations have come down. And so when you look at the trust over the last 5 years, the returns aren't that exciting. But when you look at the opportunity longer term, and we go back from the time the trust was first set up in 2011, you can see that actually the trust itself has the ability not just to participate in companies which are outperforming, but actually many of these companies produce such good returns that they outperform the mainstream market. And you can see that since launch, the trust has had a very strong period of performance. So we expect that period to start coming back. We've seen in the last year or two, small companies haven't really started outperforming. Perhaps since we saw Liberation Day, perhaps the UK small caps have started catching up a bit. But generally, the trust itself over the last 2 or 3 years in particular has actually had very strong performance, irrespective of the fact that actually small companies haven't outperformed. And so that's really related to the stock selection, the wider investment universe. Specifically, the fund does have some mining companies. Specifically, the fund does have some gold mining companies. And gold mining companies, as you know, have particularly outperformed, not just outperformed relative to the UK, but outperformed in many cases the technology winners as well. So we've got this wider pattern change beginning to happen. The UK is now currently year to date outperforming international markets. And we're actually at a period where we see not just the opportunity for many of our companies to improve and generate an attractive return, perhaps a premium on a multiple on their long-term valuation, on the original valuation we bought them at, but most particularly for investors to start changing their behavior away from that which is very aligned to globalization towards a period when nationalism is going to be more important. On that basis, this is looking at the contribution to return from dividend income. This isn't the UK stock market. This is the US stock market data going back to the 1930s. And what you can see here is actually that historically, sometimes 40, 50, 60%, sometimes more than that, of total return was generated by the income. Now, that's not the pattern in the last 30, 40, 50 years, except possibly the period between 2000 and 2010. I think that's probably a disproportionate sort of period, because what happened is in 2000, remember the dot-com boom happened, just finished in 2000. So we had a period of underperformance just in 2001, 2, 3. And then, of course, towards the end of the same decade, 2007, 2008, obviously 2009, we saw the massive sell-off in the markets. And so actually in that particular period, yes, 100% of the return was produced by the equity income of the US market. But what we have seen is behavior change, skew into people buying into companies which are outperforming on share price terms, away from income. And now we're expecting that pattern to reverse, income to becoming more important. As the income equities start outperforming, then we think, of course, their valuations go up and they can start taking serious money from others. But some people still worry. They kind of say, well, that's all very well, but that's just a short-term thing. No. As you saw in the previous slide, yes, there's long periods, 30s, 40s, 50s, and 60s, when the mainstream return is generating income. And if you get an income sector which is outperforming, then you can really outperform on a 15-year basis. This is just looking at the banking sector, of course, going up to 2008, the global financial crisis. But what you can see, that red line, is that the bank sector, an income sector, didn't just outperform, it outperformed dramatically. And I haven't just shown it versus the UK stock market. Nobody's interested in the UK stock market. What I've shown really is that purple line, which is the FTSE World Index, and that blue line, which is the S&P 500, all on a common currency, of course. So the net effect is we are looking at this period where actually returns could be driven by income. Most investors are not participating in income. As they increasingly participate in income, you get this, sort of self-feeding event, which will drive that outperformance. And the fund itself, the trust, has the advantage not just investing in mainstream income stocks. Of course, we've got some of those too. But what you can see in the largest holdings, this is a list of holdings at the time of the year end, as in May. What we can see there is, yes, there are some mainstream companies which you will know, BT, Sainsbury's, Aviva, but many of those are not well represented in other income portfolios. So the portfolio is much more broadly invested. It has about just over 90 holdings, but most particularly, many of these companies, when they succeed, they can succeed disproportionately, and they can not just generate good income, they can create good income growth for many years. And when we do sell them because they're expensive, we can reinvest in other companies which are higher income, and we get income growth as a result of that. So the trust itself is rather different from most other income funds in having a range of stocks which you just don't find. So in comparison to a global income fund or indeed a UK income fund, which tend to be particularly concentrated in many of the mainstream income sectors, this is a much more wide-ranging trust. And specifically, that's been the benefit. There aren't that many big gold companies out there, and yet Pan-African Resources, which, as you can see in this portfolio, is standing at about 4.5%. Actually, sorry, 2.5%, has moved up to about 4.5% subsequent to this going through. So when you do get some of these commodity companies succeeding, they can succeed disproportionately. But what happens if markets get more difficult? What happens if the economy gets, what happens when the next global recession comes? It's going to come, we don't know when. Well, what we've shown here is actually not just that actually mainstream companies will all come under pressure, big and small income shares, maybe some underperform as well. But most particularly the strong companies, those which are generating good and growing surplus cash, will be able to actually continue to move into the markets vacated by some of those which have gone bust. If there are zombies which go bust, or if there are companies which are retrenching, and there are opportunities to move into markets, then if you've still got some surplus cash, you can move. So what you can see is income shares not just surviving, but actually accelerating their earnings growth for a different time. And that becomes obviously more exciting if you are able to acquire what are viable businesses, cash generative businesses, perhaps in a structure which is over levered, where they go bust into the receivership, you buy them from the receiver, often not just debt free, but for a nominal sum. Many people remember in 2022 we had HSBC bought SVB, Silicon Valley Bank UK, for £1. Clearly, the HSBC share price subsequently has risen very dramatically. That's not all down to SVB UK, but let's be honest, buying it for £1 was a brilliant transaction. And so it's good for big companies, it's good for small companies to buy assets from the receiver, but it doesn't have much significance on big companies. HSBC started off at 145 billion. I don't know whether SVB added 5 or 10 billion to the market cap, but 5 or 10 billion on 145 is useful, but it's not going to change anyone's life. Further down the market cap range, you can see what I've tried to show this on a logarithmic scale is as you make a company with a value uplift, say, of 300 million, it doesn't make much difference to a large cap. It makes some difference to a small cap, but it makes loads of difference to a micro cap. And so when we're having a broad portfolio invested in mainstream and small companies means that we are not just going to be able to take advantage of the weakness of others, but most particularly some of these smaller micro caps will accelerate and greatly accelerate, potentially transformationally improve their returns. And there's a good example of that in this company, which was in the portfolio back in 2020. So this company came to market in 2017. It's involved in helping very tiny companies do corporate transactions, so buying and selling of small rows of shops and such like. But the key issue is, although it came to market, the share price went up perfectly happily. We were very happy with it. An issue in 2020, of course, not many people were buying and selling businesses. They had cash on the balance sheet. They had painful, attractive recovery prospects, but they came to us and they said, we can buy not 2 insolvent acquisitions, but 2 very distressed acquisitions in valuation at knockdown prices and make what we consider to be a transformational return. Would you like to write a check to allow us to put working capital into these businesses and revive? And we think this will generate a return which is, which will accelerate our growth, effectively. And the answer is yes, please. Thank you very much. We would love to invest in such a company. And we did, of course. We already invested and we increased our holding. And the net effect was within 3 years, they'd forecast and they were due to pay it before they were taken over. The yield on those new shares issued in July 2020 was over 10%. So follow the cash. When we get to periods of uncertainty, extra cash means extra opportunity, and the best opportunity is going to not be in the big companies, but in many of the small companies. And that's really the pattern of the past, really. If we look at currently, small companies have had a big setback in the last 5 years. If you take the US stock market, the small companies have come down in the last 5 years. And yet if you go back over the long-term period, they've come down so far now, they've hardly outperformed since issue. But actually, that's not the case for smaller companies. What we have here is the long-term returns of the UK small company sector by market capitalisation, different groups of them, and you can see that bottom line, that sort of greyish bottom line, which is effectively the Numis large cap index. Yes, £1 has been worth £1,200 over that period, but as you move down the market cap range, and this is partly down to recessions and small companies acquiring assets from the receiver and all the rest of it, you can see in the mid caps that light blue line that they make 3,600 times your money rather than 1,200 times your money. And as you move into small caps, you can see that that's 8,000. And when you get into the micro caps, that's the Numis 1000 index, that comes out at 21,000. The opportunity for the trust is to actually pick out winners in all of these ranges, not just invest in small companies, not just invest in big companies, not just invest in gold miners, invest across the full range of things and get this opportunity to get different times with things coming correct. This is the pattern we expect. My own view is that the UK stock market becomes the global leader of small caps. So I think this is going to be a longer term trend. But still, people still wonder, but what about the UK economy? What about the UK government? Surely that's not going to be a winning formula. And in a way, that's not the main agenda. The main agenda is that many of the mainstream companies in the UK are international businesses, and 80%, circa 80% of their business happens overseas. So it's not so much what the UK government does, it's more about the pattern about people investing in capital-intensive income shares. The UK has a large cohort. That's been a massive negative. This is showing the US stock market versus the UK stock market going back to the sort of 1960s. What we can see is, really, we all know the playbook since about 1985. UK has underperformed, US has outperformed, and everyone's got bored. But what is interesting is when things were more difficult, particularly in the 60s and 70s, and when there was inflation and companies going bust, and all sorts of government collapses and 3-day weeks and strike action and all the other things, actually, the strong got stronger. And the UK is absolutely loaded with companies which are generating surplus cash. And surplus cash at a time when other people are stretched for cash gives them disproportionate advantage. That is why we expect the UK to be entering a super cycle. Our view is this trend isn't just something about like catch up over the next 3 or 5 years. We're looking at a 10 or 20 year basis. And when you look further down the market cap range, of course, the UK economy didn't grow very well in the 60s and 70s. It was very much outperformed by Germany and France, which were still recovering from the Second World War at the time. But what was interesting was having a market where there was vibrancy, but more importantly, where you could raise additional capital to buy distressed companies from the receiver, like we saw in K3 Capital, meant that actually you got accelerated earnings growth. So this chart only goes up to 1988. It's not that small caps in the UK hadn't outperformed since 1988. But everything has outperformed the UK stock market since 1988. We're not interested in what's outperformed the UK since 1988, but we are interested in what happened prior to, because it was one of the best performing stock markets in the world. And you can see that light blue line. Yes, the UK was a strong market, but most particularly, as you move down into the mid and small caps part of the market, you've got disproportionately more returns. If we can pick out not stocks which, produce these returns, but pick out stocks which produce returns which are better than this, not just the blue line, not just the purple line, but the pink line as well, then that is what we think the ambition is of this trust. We are tremendously upbeat about the potential for the trust. So to summarize, the key issue isn't just about the trust, but the nature of the return we deliver. What we show here is the two sources of return: share prices, NAV performance. You can see that in the wavy line. That was fine up to perhaps 2018. We've seen subsequently increasing OIP redemptions. Not so much for this trust, but generally, and that's led to many of the small cap share prices coming down. Big caps have come down, large caps have come down, but they bought back more of their shares. They've held up better. And you can see that's been quite a wavy line over the last, say, 5 or 7 years. But what's interesting is when you consider the income which comes directly to your bank account. So effectively, you don't need to worry about whether the stock market's up this week or down next week. You don't need to time your purchases. The great advantage about income and income growth over time is it just keeps coming in. You don't have to, you're not forced to have to worry about taking unit encashment to generate your retirement income. This, we think, is going to become overwhelmingly, dominantly important, not just to individuals, but specifically to institutions. We expect institutional investors to become absolutely, completely aligned, increasingly, with good and growing income and good income strategies like the diverse income trust. We think this will be a big favour, not just in terms of generating extra return, more people buying the same stocks, but ultimately, actually, more people supporting these companies and then having the ability, with the lower cost of capital, to actually do more deals. So to summarise, the last thing is really the trust itself. Of course, the NAV will go up and down, and that will change tomorrow and next week. Don't just rely on the NAV as a good way of performance. We think that this is a really important way. The underlying income from the portfolio over the long term, and in comparison to fixed income funds, the whole point about an equity income fund is that dividends can grow. Of course, they can be cut. Don't get me wrong, and we're not against that. Clearly, when we look back to 2020, this is a May year end, the trust itself had an 17% reduction in revenue per share that year as dividends were cut. But the directors were able to look out to 2021 and the forecast for May 21, and they actually decided to pay out from reserves, not just a maintained dividend, but actually an increased dividend in the year to May 2020. And then, of course, subsequently, as the income grew, you've seen the underlying dividend from the trust grow. And with the vote today on the AGM, the final dividends will now be paid and the record will be made up there. So the bottom line is, we think this is a strong line. If you look back to, say, FTSE 100, look back at the FTSE 250, since 2019, of course, the dividends came down, the payouts came out. But what's happened is, although dividends have recovered FTSE 100, they've recovered for FTSE 250, according to the computer share dividend monitor. Effectively, what we've seen is actually the income has not recovered back beyond 2019 levels. But in this trust, not only did it not go down, it's actually continued to increase. We think that's the advantage of the multi-cap approach, and we think that's the advantage of having a range of sectors, gold companies at the moment and other companies at other times. And to conclude, the bottom line is really, we think that actually the trust is superbly positioned, not just to generate a long-term return, but in the nature of how it invests in strong companies. And we think with uncertainty, we think strong is going to get stronger. If there is a global recession, whilst we won't say the NAV won't change, it may suffer a setback. We think the companies only get stronger, or many of them only get stronger, as they take advantage of the weakness of others. Ultimately, we think that the UK stock market starts to become a tailwind. If we're right about a super cycle for the mainstream markets and of course small companies, then we think that would be even more advantageous. Bottom line is, we think the prospects for the trust are very upbeat. We are tremendously confident about the future.
Thank you, Gervais.
Perfect, guys. If I may just jump back in there, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that have been submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboards. Guys, as you can see there, we have received a number of questions throughout your presentation this afternoon, and thank you to all of those on the call for taking the time to submit their questions. But Claire, Gervais, at this point, if I may just hand back to you to read out those questions and give your responses where it's appropriate to do so. And if I pick up from you at the end, that'd be great. Thank you.
Thanks, Jake. Yes, we've had a few questions in, and there are a couple of questions here about the annual redemption facility, which, as followers of the trust will know, is we've just gone through that process, although the end result is not yet completed. So if I can turn to you, Gervais.
I mean, the first thing is that it's not just down to me. The board need to opine on this. As Claire says, we're in the middle of a redemption mechanism. The last redemption mechanism was about 30%, so a very significant outflow. Clearly, the trust has got bigger, so although it's 30% down, clearly the trust got bigger along the way. But most particularly, I think this is a live conversation in terms of the board is, this is something which is shareholder friendly, and whatever we do going forward is going to have to be shareholder friendly. If there are ways we can think about adjusting the mechanism or making it better in terms of long-term shareholders, then I'm sure the board will be interested. We haven't concluded on that, but whatever we do will be shareholder friendly, because if it isn't shareholder friendly, it won't get the shareholder support. So it's as simple as that.
Yes, Okay. Right. Second question, Gervais, what is your current view on the advantages of holding put options in uncertain times? The Trust doesn't currently have a put option.
It doesn't have a put option, no. I mean, the great advantage of put options is that they cost a small amount of money and you can make out really low. Of course, they can come in when the market's... What's been interesting is actually, over recent years, is that actually, if you have had put options, and we have had put options in the past, we haven't in the last 2 or 3 years, but most particularly we've had put options in the past, you actually detract from the return. So actually the return would be slightly less if we'd had the put option in the past, because you would have paid the insurance, you wouldn't have got anything. So actually at the moment is we don't have a put option. I think the board is open to the conversations, but at the moment the view is that actually they'd rather not have one rather than have one at the moment.
Okay. Then another question, are you seeing attractive dividend growth prospects emerging in any overlooked parts of the UK market that could contribute to future returns? Don't know if you want to give away all your secrets, but
well, the area which we do think that most investors are probably a bit too kind of cautious about is that nearly all institutional investors love a company which, you know, generates 2 million in profit, and then 4 million in profit, and then 6 million in profit, and then 9 million in profit, and they love that kind of stepped inclination. And whilst that's great, and I do think absolutely there's a position for many of those kind of companies in our portfolio, we're probably more wide-ranging, Martin and I. We invest in lots of some companies where the underlying cash flow is much more uncertain. You can look at some of those, you know, companies like Plus 500, for example, which trades, you know, it's a trading company. If you look at some companies like some of the energy companies, you know, clearly oil price is up and then it's down and stuff like that. And of course, most recently we've seen mining companies. The trust itself is heavily invested in mining companies, probably just under 15% of the trust. Is that right? I can't remember. Anyway,
yeah, I think it was 15%, but a proportion of those were,
and only a proportion were gold companies. So coming back to it, the nature of it is that these companies don't just get lucky. In some cases, they get very, very lucky. And so you generate a disproportionate return, you get abnormally large dividend growth, the share prices scream up, and then you can take profits and recycle that capital into other income stocks, which are much higher yields. And in doing so, it's very advantageous. So coming back specifically, yes, we think the mining sector is very overlooked in terms of generating not just attractive returns, not just good share prices, but actually the opportunity to make disproportionate return, which can then be recycled into other areas. And it's not just gold mining companies. Yes, we have some gold mining companies. Yes, we have taken some profits. We think copper is quite interesting. We're starting to look at, there's one or two holdings, cobalt and other things where we're also interested. So it's quite a wide range of different metals.
Okay, lots of opportunities there. I'm just going to finish with a couple of questions that were asked at the AGM today, which I thought were quite interesting. There was one shareholder who asked about the fact that you hold both Aviva and I think L&G in the portfolio. L&G, M&G?
We've got Legal & General. We have got M&G as well, as it happens.
Sorry.
Yeah.
Aviva and Legal & General, and they were commenting on the difference in yield, and that Aviva on the one hand is around a 5% yield, and L&G is around about a 9% yield, and why the difference? What's the story?
Yeah, so what's interesting about these companies is that they are both operating in the same sectors. They might grow at slightly different rates, but people are saying, how can they be such different valuations was the question. And actually what was interesting is, in a way, it just illustrates just how much difference a talented management which is able to really be effective in telling the story makes a big difference. And I would argue Aviva is very good at telling the story. And I would say that in comparison, although Legal & General is a strong business, I don't think it's as good as telling the story. And so we engage with lots of companies to talk to them about how they can tell their story and how they can be more effective. And it's amazing. You can get enormous changes in share prices just on how you tell a story. So I think that's the actual answer to that question.
Okay, and then just the other one, which is sort of perennial favourite, is takeovers. Are you seeing more takers, less takeovers? Investors maybe think they like takeovers, but you're not so keen.
No, I mean, of course we do get takeovers, and whilst everyone says, well, it's lovely, you invested now and you get 50% up the side, you get more return quicker, and that's probably true. But really, the person taking over the company is usually going to make out like a bandit. We're not interested really in someone who's going to make 5 times their money selling our clients' holdings at 50% premium. So we push back quite hard on this, actually. Often they come to us, we may be significant shareholders, and they ask us to sign what's called preemption, sort of commitments to vote in favour of the takeover, and we just say no. And obviously sometimes they say, well, it might not happen, and we say that's fine by us. Now, to be fair, nearly all the time it does happen. So nearly always someone else signs these agreements. But most particularly, we think that actually that just underlines the quality of some of the holdings, the uplift of them, the cash generation. So we're reassured. We've probably had 25 takeovers in the last 5 years. As I say, I think we signed one of these agreements in one case only. So we've been pretty confident in the underlying quality of the company, and that's really where we are now. We're not changing the portfolio very much at the moment. We're tremendously upbeat about the nature of the portfolio and the scope of it to improve from here.
So I think, would that be your summary?
I think my main summary would be, I think there's a correlation question mark coming up. I think it's going to be challenging, and I think that's going to radically change investor behaviour. I think, how do you get diversification from this capital appreciation transaction-led strategy? The answer lies in income and good and growing income. So we just happen in the UK to be in the right place, not because we're better than anyone else, not because our government or our economy is better than anyone else. It just happens to be where we are. I'm upbeat about that. But if anything, I'm even more upbeat about smallness. Small companies have had artificially, they've been devalued relative to the main market, artificially devalued versus the international mega caps as well. The net effect of both those factors is tremendously upbeat. Together with stock selection, I couldn't be more upbeat than I am.
Thank you very much, Gervase, and thank you to everyone for joining us this afternoon. Jake.
Perfect. Claire, Gervase, thank you very much indeed for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of the Diverse Income Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.